It is impossible to trade or invest and not find yourself into the losing positions. That's just the way things are. And the large trading loss can be devastating not only financially but emotionally, as the defeating the as losses feel. How you react to the big loss is more important than the loss itself. In experienced traders suffering a large loss can become hijacked by their emotions. Some may try to trade through the pain, others creating more turmoil for themselves. Some may withdraw from the market to avoid thinking about it. Others may try to trade in leverage, determine the recovery or the losers. None of these reactions are constructive. In fact, they can be destructive if you don't learn how to handle losing traders. Whatever it was an obvious minus in your strategy, a lack in the discipline, or any other reasons, nearly every traders will face a big losses or several in their career. After losing the stick or a big loss, you may begin to questions yourself, which leads to the typical problems many new traders have, like getting out of the traders too quickly, holding on them too long, skipping traders with the fear of the losing or getting into more trades then you should in the attempt to get some winning traders. One major difference between the successful traders and failed ones is how they handle trading losses. Successful traders treat losses as the opportunity to learn to improve their trading. Coming back from the large losses in the challenging, but success is never accomplished with ignoring traders' losers. Losers, especially substantial ones, can be opportunities to become more skillful traders. Here's the 7 rules successful traders take after to lose to become the emotionally stronger and more disciplined. Number 1. Never let a bad day cost you more than you make on average with the day. Knowing how you lose properly is the must in a long and professional trading career. If you average, let's say, $200 in your winning days, don't lose much more than that. On a bad day, control the downside, knowing how to minimize risk in the most important aspect in the trading. There are really only 4 possible outcomes to the trade or investments: a big win, a small loss, or the big loss. As long as we eliminate the big losses from our trading days, we can live comfortable with the other 3. Risk management in the primary case for the successful or unsuccessful trading experience. A sound risk management can yield a steady increase of the profits, while a proof risk management can wipe out an account in a very short period. If you follow the 1% risk per trade rule, preset stop loss level percentage is at the 1% value, and you know before here the amount you risk losing should your trade turn negatively, and this goes hand in hand with the second rule too. Know the stop loss level before you ever get into the trade. The stop loss is a simple tool, yet so many traders and investors fail to use it. Whatever to prevent the experience losses or the loss of the profits, nearly all trading styles can benefit from these trades. Think of the stop loss as the insurance policy. You hope you never have to use it, but it's good to know you have to. The protections should you need it. So always use the stop loss and know its locations before you ever get into the trade. Also, never wild your stop losses when the market moves in the negative territory. Know that regardless of what happens, there is another trade around the corner. If your trading strategy relies on the success in one single trade, it's a very bad trading strategy. Remember that trading success is the accumulation of the many successful managed both winning trades and losing trades. Number three, don't involve in leverage trading. A big loss caused in all sorts of the inner conflicts, need for revenge, fear, anger, furnace, self-hate, market hate, and the list goes on. After the big loss, there's no way to trade with a clear head. There are more than 250 trading days in the year, so there's no rush to trade back in this. If you do so, you basically average trading. Rather than that, looking for your strategy and make sensible decisions around the insights, you jump straight back in. This is the dangerous for your account for two main reasons. First, it forces you to throw your trading disciplines out the window. In the shift, use your focus from the trading process to trying to make enough money to recover your losses. Trading based on the emotionals and luck is not trading, it's gambling. It's also lose situations. If you lose a average trades, you increase your losses even more with the trades that you had badly planned for. If you win when you believe that the trading on the guts and emotions work for your going, do it again, so don't do it. Number four, accept responsibility. If you suffered a large loss, be sure to own it. Don't brush it aside, hide from it, or blame it the smart money for your loss. There is always an exclusive for the losing trades, but the traders and investors, we must accept the risks until we accept what we are responsible for. Whatever happens with our orders, the same thing will happen again. Accepting responsibility and figure out what could have been done differently. This will help to reduce the chance of the occurring again. It is also healthier that blaming other factors for your mistakes. Blaming other is admitting you don't control your own trading, and if that is in the case, you shouldn't be trading at all. If you control your trading and investing, then you can fix it, and it's always something that can be done. It may involve the changing markets, changing your strategy or your trading styles. If you find that scalping the 1 minute chart brings you a lot of losses, try swing tradings. The solutions is there, you just need to find it. Number five, stop trading for a while. Sometimes it's better than to take break to figure out what went wrong. Do those things so you can get the back and the better mind test in which you can refocus. After that, access that happens by the rewarding events carefully. Think about where you fell short. For example, did you take too much risks? Was the trade well planned? Were you mentally sharp, or did you hold the losing trades hoping to avoid a loss? Taking a break from the trading is one of the hardest things to do, but it's a smart move. Wait for the conditions to improve. Preserve your cash, saves your sweat, and focus on the other things. When the conditions improve, so will your results. Remember, the market will not disappear tomorrow. Nothing terrible will happen on the certainly during this time away from the charts. You will likely to come up with the new, better ideas on how to improve your trading. Number six, trade levels, position size after the big loss. confidence can be low. Not having the clear mind can cause you to skip trades, panic out of the trades, or be overly aggressive. None of these are good. Take the step back and trade in a demo account for a few days because it's not real money. There is also less pressure on the demo account, so it is easier to focus on the trading and not worry about the financial aspects of it. A few winning days in a demo account will raise your confidence level and put you in the better mental space to take the market against with real money. So after a losing stick small, don't jump right back to the same position size you were trading before. If in the first days back, trade small position sides. A winning day with the small position sides will have to build the confidence, and you can slightly increase your positions size as the account balance goes up. If you have a losing day, losing on small position sides, it's easier to handle that another losing day on the full position sides. Even if you win a few days in a row, increasing your position size incrementally, so it takes about a while to get back to your full position size. I know that after you have the trade bigger position sides, it's annoying to start back with small position sides, but it's for the best. Bouncing back from the losing stick is about to get back to the basic and implementing a strategy well, not actually about them making money. Money comes from the implementing a strategy well. Demo trading and trading small position size gets you the focus on the what's important, so you can start building your confidence again. Number 7, let go of the outcome to the embrace to the process. Realize that trading is not a continuous process of learning. Most of the times in trading, like in the real life, you learn more than from the mistakes than from your victories. Losing money should motivate you to look closer at your actions, read more, better educate yourself, become the more disciplined in your exclusive, and so on. Next time you will have the better ideas of what happens and where you went wrong, and can open a room for improvement and start staking the odds in your favor. As cycles as it sounds, putting your focus on the making money and into enjoying the process will keep you on the right track and more likely end up in the profit. If you learned something new and you found value, leave us a like to show your support. Subscribe to our channel and hit the bell icon to stay in touch with the new uploads. Until next time.